Amazon, Nvidia, Apple, Alphabet, and Microsoft. 5 stocks with market capitalizations above $2 trillion each. But which one will get to $5 trillion first? The race to 5 trillion. I'm going to compare these 5 mega cap companies and answer which one I think will reach a $5 trillion valuation first. In order to make this evaluation, I'll compare these companies on revenue growth, on profit margins, on returns on invested capital. I'll also look at their valuations on a forward price to earnings basis, and I'll share with you my proprietary discounted cash flow valuations that I've created for each of these 5 companies. And finally, at the end of the video, I'll give you my conclusion on which one I think will reach that $5 trillion market capitalization first before any of the others do.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, so looking at their current market capitalizations, Apple has a head start because its market cap is 3.3 trillion. It's the closest to 5 trillion, so it has the early advantage. Then we have companies like Nvidia with a $2.97 trillion valuation and Microsoft with a $2.9 trillion valuation at second and third place. Fourth place is Amazon at 2.1 trillion, and finally Alphabet, the least of these, at $2 trillion market capitalization. So one of the things that's going to determine which one of these companies reach the 5 trillion market cap first is revenue growth, because these are all very profitable companies. If they grow revenue, it's very likely that they're going to increase their profits and thereby increase their valuations, because valuations are closely connected to a company's profitability. Even though you might hear rumors that profits don't matter, valuation doesn't matter, the stock market trades on momentum, on enthusiasm, on etc., etc., etc. In the long run, stock prices reflect the business's profitability, because that's what you're buying when you're buying a stock. You're buying a share of a business. And as a person, when you're buying another business, what's the price you're willing to pay for that business, if not directly related to how much profit you think that business will earn you in the long run? Somehow, when we treat these things on a larger scale, we forget that connection between a business valuation and a business profit. And so when you get to some of these companies, that gets distorted, and that's really dangerous for investors. I caution you not to go along those lines of thinking that stock prices are not connected to a business's profitability. They surely are in the long run, even though in the short run it might not seem that way. So looking at revenue growth, one is a clear standout against the others, and that's Nvidia. You've seen Nvidia's growth rate absolutely surge starting in 2023. Revenue growth, the company delivered over 200% revenue growth for several consecutive quarters, which was truly unprecedented of a company at this size and scale. This type of growth rate usually happens with much smaller companies, not companies that are already generating billions in revenue. But Nvidia has managed that for several consecutive quarters, and even in the most recent quarter at 78% revenue growth, it was far ahead of anyone else, the next highest being Microsoft at 12% revenue growth, Alphabet at 11.7%, and Amazon, the only other one, growing over 10%. Now, looking ahead over the next 5 years, I expect Nvidia will continue to dominate the rest of these companies in terms of revenue growth for at least the next 5 years. The next thing that will be critical for these companies approaching the 5 trillion market cap is their profit margins. Investors are usually willing to pay higher prices for businesses that have higher profit margins. And that makes sense, right? If you have a business with higher profit margins, that means the business has stronger competitive advantages and can withstand stronger economic headwinds and still generate profitability, because it has room to lower prices, it has room to do other things in order to stay profitable even during difficult circumstances. And in this regard, Nvidia, again in the lead here at 62%, and the next closest is Microsoft at 45%. Although in this regard, I'm not as confident that Nvidia will maintain this advantage for the next 5 years. I think Nvidia's operating profit margins will remain high for maybe another year or two, and then those profit margins could come under pressure. The company doesn't usually generate profit margins at these levels. You could look back over the previous decade. It hadn't generated these margins before. In the current circumstances where its products are sold out, it's able to command premium prices, and I suspect that will remain to be the case for the next 2 years. But then after that, it becomes a question mark. I still think it's the one that's most likely to generate the highest profit margin over the next 5 years, but I'm less confident in the margins as I am in the revenue growth. Still, out of these, I think Nvidia has the best chance to generate the highest margins, while I think Amazon has the best chance to grow its margins from 10.75%. I wouldn't be surprised if Amazon's margins approach 15 to 20% in the next 5 to 10 years, as the company has demonstrated an excellent ability to benefit from its growing size. All right, the next important metric is returns on investor capital. This is pretty much what businesses get judged on, right? How good are you at taking money and turning it into products and services that generate profits? That's basically the whole idea of a business. Take money, turn it into products and services that generate profits. That's what return on investor capital measures. Nvidia, again, in the lead here at 107%, with the next closest being Apple at 56%. No other company even approaches 40%. And in this regard, I'm of a similar idea to the operating margins, in that I fully expect Nvidia will be the leader in this metric over the next 5 years. However, I'm not as confident that it will be the leader in this metric as I am with revenue growth. Still, I think it has the best chances to opt to generate the highest margins, especially because of the business model. Remember, Nvidia does not manufacture its own products, it outsources the manufacturing to other companies, including Taiwan Semiconductor. And Apple has a similar strategy, which is why Apple generates very high returns on investor capital too. When you outsource manufacturing, that's a big capital investment, right? The company that I highlighted earlier, Taiwan Semiconductor Manufacturing, regularly spends over $30 billion every year on its manufacturing facilities, and it's already built a strong base to its manufacturing facilities. So if Apple or Nvidia all of a sudden wanted to manufacture their own products, that would cost them hundreds of billions of dollars to build up the manufacturing facilities required to be able to bring that in-house, and that would lower their returns on investor capital. So this strategy has helped these companies generate higher returns on investor capital, which I expect will persist for the very long run. Now let's look at valuation. And when measuring on a forward price to earnings basis, the company that's the cheapest is Alphabet at 16 and a half. And the cheaper company usually has a better chance of increasing its market cap, because I highlighted that one of the ways you increase your valuation as a business is by increasing the amount of profits and cash flow you generate. Another way you increase your valuation as a business is by increasing the price that investors are willing to pay for those profits that you generate, right? This is called the multiple. And the price to earnings multiple is the multiple that you pay per dollar of earnings. And this can fluctuate. And if this increases and expands, it increases the market capitalization. And in this regard, the most expensive in this set of companies is Amazon and Apple at forward price to earnings of 26.6, and Nvidia's in the middle there at a forward price to earnings of 21. I expect Alphabet and Nvidia to experience an expanding multiple, a growing multiple over years. I expect investors will be willing to pay a higher price to earnings multiple for these two businesses over the next several years, while the rest, I feel their price to earnings multiple will remain roughly where they are right now. So approaching valuation on a different way, using my discounted cash flow valuation, looking at Apple stock, it looks overvalued to me. I have the intrinsic value per share at $161, while the market price is $219. Similarly, when I look at Nvidia using my discounted cash flow valuation, the stock looks undervalued at an intrinsic value of $143, which, by the way, I increased today because the risk-free rate is lower today than where it was when I last updated my discounted cash flow for Nvidia. So my current up-to-date March 24th, 2025 intrinsic value per share for Nvidia increased to $143 as I lowered the risk-free rate. The current market price is $122, so there's room for expansion there. Microsoft, the intrinsic value per share also looks undervalued at $460 compared to the current market price of $392. Alphabet also looks undervalued with an intrinsic value of $205 and a current market price of $166. And finally, Amazon also looks undervalued with an intrinsic value of $325 and a current market price of $202. So, according to my discounted cash flow valuations, 4 of the 5 businesses look undervalued. Apple is the only one that looks overvalued according to my DCF. So, all that being said, which one of these 5 companies do I think will reach the 5 trillion market capitalization first? I think it's going to be Nvidia. My estimate is that Nvidia will reach the 5 trillion market capitalization first before any of these other companies do, while these other companies are also likely to reach this milestone over these next 5 to 10 years perhaps. I think Nvidia will be the first one to reach that milestone before any of the others do. Hey everyone, so many of you have been asking about my investing strategy, and I'm excited to announce that I've written a book that's available for sale now that describes my 6-step investing framework for evaluating stocks. I've added the link in the description below.